Welcome to this Maples Group Tax and Coffee podcast, a series where we discuss EU and international tax developments. I'm Andrew Quinn, I'm Head of Tax at Maples Group, and I'm joined by David Burke from our Irish law firm. We're going to discuss the EU Global Minimum Tax Directive and consider its impact on investment fund structures. So look, a quick background on the global minimum tax. This came out of the OECD base erosion and profit shifting process, which was commissioned by the G7 group of countries. It is a global initiative, but within the EU, the measures are being brought in by EU legislation, and that is the EU Global Minimum Tax Directive. And like all EU directives, the process is that is implemented into national law by each member state, consistent with the terms of the directive. So David, how is that being implemented in Ireland?
Well, implementation sort of started off in earnest when the OECD model rules themselves were published in December 2021. And at the same time, the draft EU directive was published, which largely followed those OECD sort of global rules. And the directive was then approved by the member states a year later in December 2022. And in terms of Ireland, the Department of Finance published their feedback statement earlier this year in March, and another one just a week ago, with a view to getting stakeholder input on the draft legislation they published so that it's tweaked in time for September 2023, when we expect the finance bill to come out. And then the idea would be on the 31st of December 2023, the legislation would then be in force in Ireland.
So right around the corner, and of course the process and timing is the same all across the European Union. When you run through that there, David, I mean, look, the implementation of this in the EU and globally has been very, very fast. You know, there were commentators saying that this global minimum tax never had any chance of being implemented. Even in the EU, there were certain member states that didn't support it initially. Hungary, for example, was one of the countries to hold out, but eventually, as you say, the deal was done right around December last year, 2022. So in addition to the EU, many other big countries around the world are implementing the global minimum tax, the UK, South Korea, Switzerland, and others. Not the US as yet, but some of the traditionally low-tax jurisdictions have also announced that they will be introducing the global minimum tax. For example, Bermuda, Jersey, Guernsey, and the Isle of Man. So David, who does this global minimum tax affect?
Well, high level, it just applies to groups with an annual turnover revenues of at least 750 million euros. And group, for this purpose, is consolidated group for accounting purposes, although in some cases it could include groups that are of entities that are related through ownership or control, but not consolidated, or rather they should be consolidated according to acceptable financial accounting standards. Generally, so accounting is important. So and it's also subject to change and interpretation. So that needs to be borne in mind. Generally, it's cross-border groups, but in the EU, it could be a solely domestic group. This is because of the sort of EU freedom of establishment requires that, and Ireland is likely to introduce that provision. So headline, it's international groups, consolidated for accounting with revenues of over 750 million. Andrew.
Thanks, David. So here's the science bit, and this is how the Global Minimum Tax Directive in the EU, but more broadly, of course, through the OECD. Here's how it operates. The objective is to make sure that those large groups that David described will pay at least 15% tax on their profits in every country in which they operate. Okay? Now, of course, the G7, the OECD, the EU can't go out and make sure that every country in the world imposes tax to that level. So the way that is achieved is basically to say that if your group has a legal entity in any country that has implemented these rules, then effectively the whole group will be subject to that 15% tax. So that's the way it works. Very complicated set of interlocking rules. The income inclusion rule, undertaxed profits rule, the qualified domestic top-up tax, but in essence, they're all aimed at achieving the same thing. I mean, if I can give an example, a very simple example, let's say you have 3 companies in your structure: a US parent entity, an Irish subsidiary, and let's say an affiliate subsidiary which is in a low tax or zero tax jurisdiction. So the way the EU directive works is, because that group has a foothold in the EU, that Irish company will be taxed not just on its own profits, but also the profits of that US entity and the profits of that zero tax entity, assuming they don't pay tax at the level of the 15% rate. So that's the basis behind the tax directive. So let's move on now to consider investment funds and, most importantly, the safe harbour that exists within the directive. The directive carves out certain industries. For example, the international shipping industry is largely carved out of the effect of these rules. And so too are investment funds, assuming they fall within the definition in the directive. So why that safe harbour? Well, it's long been accepted and recognised by governments and by the OECD that investment funds should be tax neutral vehicles. And the reason for that, of course, is not to impose a double layer of tax on the investors. So to give a basic example there, if I invest, I'm taxed on the profits. If David invests, he's taxed on his profits. But let's say the two of us pool our money together. We invest through an investment fund entity. That investment fund entity shouldn't impose an extra layer of tax on that income. And as I say, that principle has been long recognised. And, you know, if you look around the world at anywhere where an investment fund entity is set up, be it somewhere like Ireland, the US, Germany, France, or in a traditionally low tax jurisdiction, that same principle applies. The fund entity is most generally not subject itself to tax. So David, how does that translate in the directive?
Well, that translates into the directive through the definition of an investment fund, which is an excluded entity, provided it is meets these conditions. It has to be an entity designed to pool assets, which the example you've given certainly is. It's got a number of investors, some of which are not connected, so it can't just be one or small group of investors. It's got to be subject to a regulatory regime in the jurisdiction in which it is established. It must be managed by investment fund professionals. And importantly, it has to be excluded, it has to be the ultimate parent entity of the group in scope. So that may be fine, but there's a lot of funds or entities that would describe themselves as funds that are just middle tier entities in the general fund structure, which may not be the ultimate parent entity and wouldn't be excluded, unless another exemption applies. And those other exemptions include, governmental entities, which are thought to include sovereign wealth funds, pension funds, real estate investment vehicles that are an ultimate parent entity, and also asset holding entities that are held as to 95% by another excluded entity, such as an investment fund, provided that investment fund is, an ultimate parent entity. So that's kind of the main exemptions. And if I may, I'll just mention one other quite important exemption, not necessarily in connection with funds necessarily, but it could apply to funds, is the sort of 5-year exclusion from the rules for groups that are just starting their international growth. If a group is in the first 5 years of its international activity, then it's excluded, and that is actually defined as being when it's in less than 6 jurisdictions, and sometimes it's called the rule of 6, and the tangible assets outside the main jurisdiction of the group is less than 50 million euros. So that provides an important sort of breather for those groups just starting off in life, but also other groups during the first few years of these rules.
Great. Thanks, David. So I suppose turning to what investment fund structures may be in scope, again, that definition that David has gone through is quite broad, but of course the devil is in the detail. So we're talking about structures that are consolidated, or that should be consolidated because of the control that exists, and that have that large euro 750 million per annum turnover. So let's assume that that is the case. The most obvious example, going back to that legal definition in the directive, would be a closely held fund. So there is a requirement that there are a number of investors, some of whom are not connected. If you had, for example, a wealthy family office holding their investments through a fund structure, and that is not uncommon, the fund structure would give that family perhaps good governance, maybe a regulatory oversight to their investments. You would not expect that those family members would be regarded as unconnected for the purpose of the rules. Or in the business arena, it is certainly the case that large multinational companies can hold their investments through a fund structure. The insurance sector, for example, is a good example of that. And again, you would probably not expect that single corporate holder would be regarded as again, a fund where there are a number of investors. David, moving on, I suppose, to the next part of the definition, the regulatory regime.
Yeah, I mean, that's another, condition which reasonable minds can differ as to whether a regulatory regime is a suitable one which applies to the fund in question. There's different levels of regulation in different jurisdictions.
Yeah, and certainly in Ireland, I've seen quite lively debate there as to how the Irish authorities would judge that, how they would judge, I suppose, in particular, a regulatory regime of the fund or of its manager where that's outside the EU. So that's certainly one for discussion. Absolutely, if the fund or manager is not regulated, it's in scope. But even then, there is a question there of testing the regulatory regime at the very least. What other examples then, David, might come in scope?
Well, we're considering sort of maybe a private equity fund that holds a portfolio of companies or groups of companies, which it consolidates. I mean, it may hold those through a stacked series of companies and holding companies, and what they would describe as funds. But those middle tier entities may not be regarded as asset holding companies for the purposes of the rules, because they themselves are involved in an active operating business, or they may not themselves be the ultimate parent entity of a consolidated group, so they're not entitled to the investment fund exemption. Or there may be some co-investment structure whereby any of those middle tier or fund entities are not held as to 95% by the ultimate parent entity in the group. Very common. So there's a number of, I would say, reasons why entities within a group structure or multi-layered fund structure might slip outside the very specific excluded entity definitions that we have.
Yeah, I agree with that, David. Yeah, I mean, I've even seen debate, and this was part of the submissions that were made to the OECD by various fund organisations, that, yeah, absolutely, the operating business owned by the private equity firm is certainly not, you would say, an asset holding company, but even active, let's call them companies within a classic fund structure, actively managing assets, query, are they also asset holding companies? So one other case we're coming across in practice, and it is subject to much discussion as well, is the not uncommon case where you would have a large single investor alongside others in an investment fund, and that large investor has a controlling interest in the investment fund, so more than 50%. Again, not an uncommon situation. Often a fund will start life with an important seed investor. So if that investor consolidates the underlying investment fund, that means automatically that the investment fund is no longer an exempted entity, because you'll recall that a investment fund, to be an exempted entity, must be the ultimate parent entity in the group, the UPE. And because the investor is, the investment fund will not be. So certainly that investor may be subject to a top-up tax, probably under the income inclusion rule, in its home jurisdiction. Now, how does that affect the fund? Well, the fund, of course, may be in the same jurisdiction as that investor. If not, this is where it gets quite complicated, because even though the investment fund is not an exempted entity, it would still probably be regarded as an investment entity, and an investment entity is carved out of some of the top-up taxes. So, for example, the income inclusion rule as it applies to what's called an intermediate parent entity in the group, and also the undertaxed profits rule, the UTPR. But the investment entity could still be caught by the other top-up tax, the QDMTT, the Qualified Domestic Minimum Top-up Tax, if a jurisdiction in question had effectively dictated that that would be the case. So that'll depend on the jurisdiction in question. So certainly needs to be analysed where you have that scenario. I think just one or two final thoughts then on cases where investment funds may still be within scope of the rules. David, you and I were discussing the definitions and the requirement that to be a investment fund for the purpose of the rules, the investment fund must pool assets. Again, I've seen debate to say, well, what does that mean? For example, if an investment fund, a private equity fund, held one large portfolio company, so one large multinational group as its investment, would it then be said to pool assets? Probably not on its face. And then the last scenario that I wanted to mention, and again, it's certainly something that comes up in practice, is a investment structure that is, I guess, commercially called an investment fund structure, but really it's a corporate group. So it's probably a privately owned parent entity with a number of investors. But again, the parent entity, which is part of a consolidated group, just isn't an investment fund, so doesn't meet those definitions that we went through earlier. So again, that structure would have to be looked at. So look, there's a few examples that we've come across either through discussions at industry level or in practice. I think that the takeaway from that is that it is necessary to have a look at existing fund structures before the 31st of December this year, to consider those rules when putting in place a new fund structure, to go through this in a methodical fashion. Is it a large fund structure? Firstly, of course, is it going to be potentially over the turnover figure immediately or in a few years' time? Is it consolidated, or should it be consolidated? And then going through the various definitions and safe harbours and seeing if they apply. It's certainly something we're seeing come up in terms of questions from investors. It's something we're seeing starting from the audit letters which come in from the accountants at the end of the year when they are doing their audit. And indeed, it's finding its way into legal documentation now. For example, funds are looking to investors to give a representation that they will not be consolidating the entity, because of course that can bring the entity within scope, as David described. We're seeing disclosure language in fund prospectuses as well. So with that, I'd like to finish up and thank you, David, for joining us today. That was a great discussion about the EU directive, just around the corner, of course, and there's a lot in it and a lot to be considered. And to thank everybody out there for joining us. We have more Tax and Coffee podcasts coming, so please keep an eye on Spotify or wherever you get your podcasts. And with that, thanks again and see you soon.